what are some warning signs that we should be aware of from money managers that they may not be looking out for our best interests, which we discussed a little bit earlier?
If there's an excessive degree of activity in an account that you have not authorized, I'm going to be a little suspicious of that. Is it in my best interest to take advantage of short-term capital gains and capital losses, or are we in this for the long term? If the advisor is not communicating with you on a regular basis, or is out of town a lot and you can't reach that person, I'm going to be suspicious. I want to make sure that a question that you would ask your advisor: am I going to be working with you personally, or is it going to be a member of your team? Which is fine. I'm okay with working with a team member as long as that person understands what my needs are. I want to ask questions about what their approach is. Tell me your approach. Are you buy and sell? Are you long-term hold? Do you use managed money? Do you have any proclivities relative to the markets? Do you think that the market is going to tank and you are short the market and you are out of the market? Or is the Dow Jones at 27,000 going to move on to 35,000 in the next year or so? Those are important questions. Another real important question is how do you charge? I want my charges to be very transparent. I want to be able to understand them, to read it, and say, okay, I get it, and this is fair, so on and so forth. There's three different ways that advisors will charge. There's a commission-based, and that might be very appropriate for buy and hold clients. They want to buy 1,000 shares of Berkshire Hathaway B, or General Electric, or Walmart, or Altria, or whatever, and they want to hold it for a good long time and take advantage of the dividend maybe. Commission is perfectly fair. The second way is to be charged on assets under management. So if you have $1 million with an advisor and that advisor charges 1% annually, you're going to be charged $10,000. But included in that charge are commission-free transactions.
Okay.
For an active account, that just might be the best way to go. But I would also expect that financial advisor is providing me with not just investment counsel. How about risk management? How about overall wealth management and comprehensive planning? Have you reviewed my will, my trust work? Are you helping me minimize my taxes? It's a whole continuum of items that need to be addressed if you want that type of account. And the third account, which I recommend for the do-it-yourselfer, it's a fee for planning. It's a one-time fee. Maybe there's an annual fee to just revisit, but it might be $2,500. If the account is huge, it might be much more than that. Here's all my stuff, Mr. or Ms. Advisor. What direction do you think I should move in? They do a comprehensive review of everything you own and set you free. They say, okay.
So, and you would do that every year?
Well, you would do it initially for a higher fee, but maybe a tune-up would be another $500 or $1,000 per year just to make sure there have been no changes and so on. That's not a bad model. That's pretty good.
But you need to know what you're doing.
Yes.
You need to be well-versed in the market.
Exactly, Tracy.
So.
You have to have the confidence to go out to a Fidelity or a Vanguard and say, I want a total return portfolio. And what do you have? Let me do some due diligence on the fund selections and we'll make a decision.